Hey, everybody. Welcome to Profit Pathway. I'm super excited about today. Some of you have met Brad Gibb in the past, but he brought something a little different last time, and it was really focused on the education part of what he does. And I was like, you know what? My clients have really been asking lately for the investments. I educate y'all to death, I think. And I'm always giving y'all more and more. And like, okay, guys, like now you got to make the moves. One of the big focuses for this year is really shifting our calls, our monthly calls, the ones that you get on with your strategist, to more of wealth building calls and where you want your wealth to go. And all of you know that our focus is tax strategy infused wealth. We want to create wealth that you don't have to pay taxes on, really tax-free wealth. And so that's what we're trying to bring in, investments that will jive with that reasoning, because all of you are looking at different things, right? Some of you are looking at acquisitions. Some of you are looking at real estate. Some of you are just growing your own business and you're like, I want something so hands-off that I don't have to do anything. And so we're going to get started. And Brad is here and he's doing something he's never done before, which is super, super exciting. He is actually going to talk about 3 investment opportunities that he has right now. And guys, you have to pay $10,000 in his group to get these investments. Like, he doesn't do this. So this is super exciting because I'm like, my clients just want in your mastermind and have access to you.
That's important, Carlotta, because we don't invest with everybody because most people are jerks and I don't want to hang out with jerks all the time, right? So we make them go through all of the education and we turn them in to make sure they're awesome people, so that they're people I would enjoy hanging out with, because we spend, just like you, Carlotta, we go way overboard when it comes to educating. And if I'm going to spend a bunch of time with you, I want to hang out with cool people. But Carlotta, that's what we kind of, you finally broke me down and you're like, my people are really cool, trust me. So we're willing to just break out what normally you have to go through all of our hoops and get to the highest level of what we do. And then we can open the doors of what we're talking about investing. And it's been a long work in progress. We did kind of a presentation a little while ago about the education side of what we do. This is just the highest level portion stripped out of what does investing with us look like, and how do we do that? So I'm excited to be able to invite all of you awesome people to do this with us. But you're right, Carlotta, outside of this, yeah, it's 10 grand a year to hang out with us and have access to this kind of stuff. So super valuable.
Yes, that makes me so excited for the whole thing, because I've been begging for this forever. And Brad's like, but we don't do that. And I'm like, but that's what we want. So guys, I just want to give you a little background on Brad. Him and I have been trying to figure out how to work together for the past 3 years, and really bring you guys everything that they offer, but at the level you want. And I think that that's what this is. You're going to hear from him today about the investments. In a couple of months, he's going to come back and he's going to talk about another part that all of you need. And then we're looking at getting all of you guys a game plan, and where you have your tax strategy plan, which is done by us, and you have your wealth plan, which is done by Brad. And the really cool thing about Brad's group is everything they do is tax focused. You don't know this about Brad, but he's like a tax geek too. He just doesn't have an accounting firm. And so that's what makes this relationship so great. And we're super excited. So Brad, we're going to hand it off to you. And I think awesome. Your partner is here too, and he's amazing as well. He's just not as nerdy as me and Brad.
That's right. Anytime we lead with taxes, Ryan's like, ew, Brad, why don't you just take this one? I'll do something else. So yes, Ryan's on, he's listening in and you'll get to know Ryan as you work with us on the inside. Can we do something a little different to kick this off? I love, guys, who out there as an entrepreneur, at least every once in a while feels on an island, a little bit alone, don't know what to do, right? All of us, right? So I'd love to have 3 or 4 people just unmute and share a win that they've had in the last week or 2 that they've been working hard on. I love to hear other entrepreneurs out there winning. I'd like to give them a chance to share and celebrate that. Because like, if you go to a family party or whatever, like they're going to share wins of like, I ran a marathon. You're like, cool, that is awesome. But I just built this huge element to my business that have no context of like what it actually took to do that. So does anyone want to start us off with a win that has been awesome for them in the last couple of weeks? Let's do a couple of those and then we'll transition into what I've got to say. Does that work? So anybody that just feels brave and wants to share something awesome, just unmute, share with us a win. And I'm going to be awkward and sit here and stare at you guys in silence until somebody does it.
I'll share a win. I'll go first.
Okay.
We're creating this super new program that just focuses on implementing tax strategy for people that is going to be like $500 a month. And got all of you in this group know that's huge for us because we've kind of went really big and broad and we want to like serve everybody. And so anyways, we're creating that and I'm super excited about that. And I know some of you guys will be too. So
that's awesome, Carlotta. Cool. Anyone else, please share wins. I want to know that awesome stuff's happening out in the world.
Hey, it's Brenton. I can jump in.
Brenton, what's up?
We've got a pretty good pipeline of new clients coming on board, but it's always nice when you get a referral. We've actually had like 2 referrals in like the last 5 business days. And again, they're the best type of new clients because when they've referred, they're ready to go and they've heard all the good things you've been doing. So it's always nice when a couple of those just pop up out of the blue as extra revenue that you weren't really projecting.
And it shows that you're doing a good enough job that somebody would say, hey, you should do what I'm doing. That's the best kind of compliment. Know that you're on the right track. Awesome, Brent. Thanks for sharing, man. Anyone else want to share? Maybe just one more and then we'll move on. Everybody's being shy today.
They're not usually shy.
I'll share. Carlotta.
Melissa, what do you got?
Thank you, Melissa.
You're welcome. We opened a machine shop December 2020. It's a hobby. And with the help of the amazing Carlotta, we have obtained our second machine and we're a full-on running machine shop in less than a year with 2 machines. That's unheard of in the machine world, by the way.
They are freaking killing it. They were going to buy this machine and I was like, they were going to buy a rental property. And I was like, no, buy the machine.
Oh, so much better. So cool. We're going to talk a little bit about that to help people understand when investing does make sense, but that's awesome. Cool, guys. Well, way to go. Awesome. Thank you guys for sharing wins. Because again, every once in a while, I even feel on an island, like, does all this even matter? So it's a good place to come out and share stuff. So glad you guys did. Cool. All right, let me share my screen if it'll let me. There we go. Okay, I'm a slide-driven person. I'm very visual, so we're going to go through this, but I promise we're going to get right to the meat of it very, very quickly. So here's what we're going to cover for the next few minutes. I'm going to do a brief introduction because Carla already took some of that, and you guys already kind of know us, but we're going to introduce kind of the new parts of what we're doing. And then we are going to spend a few minutes getting clear on the problem because, guys, everything in this world is about problem solving, and investments are no different. Yes, there are opportunities, but we got to make sure they're solving the problem that we actually have. So we're going to frame that up as to what our investments solve first and foremost. Then we're going to get into the crux of what we're going to talk about here is how to get real estate-like returns without actually doing real estate. That's what we're going to spend our time on. And guys, be ready to stop me and interact there. I'm going to try to move to that section as quick as possible. But as we're going through these opportunities, please feel free to ask questions, unmute, interrupt me. This is not a presentation. It's more of a workshop. And then when we're done, if we've got a few minutes, we can do even more Q&A if you want. But don't feel like you have to save Q&A until the end. When we're in the deal structure part of it, make sure that I'm getting myself across clearly, that you're understanding and you're not left behind. Does that sound good? Okay, we're gonna dive in. So our mission here at Altitude on this side of what we're doing is we want to empower you to create untouchable wealth that'll last 100 or more years, okay? And like Carlotta said, we do have, regardless of, even if the government keeps printing trillions of dollars, regardless of market shifts or crash, and regardless of how high politicians raise taxes. So we have that element baked into what we're doing. We do that through 3 different strategies. So we have a strategy company where we educate. You guys have kind of got exposed to a little bit of that. We do whole life insurance, which is another strategy we'll talk about at another time. And then we have the capital side of what we do, where we help entrepreneurs deploy the capital that they have to accomplish this. So inside of Altitude Capital, our focus is to help you leverage the success of your business to create streams of income, streams of money that are actually autopilot. Okay. That is a huge element. We do some semi-active stuff as well, but especially for the entrepreneur crowd, how do we really actually make it autopilot, right? And not just pretend like it is. How do we really make it that way? And we do that by bringing you elite education, professional teams, and access to a curated selection of collateralized cash flow investment opportunities. That's a mouthful, but we'll help you guys understand that by the time we're done. Just a couple of the types of people that we work with. If everybody knows, understands, has been exposed to ClickFunnels, Russell Brunson. He says this all the time. He just makes money and then gives it to us and we turn it into more money. Because we've been able to do it completely autopilot and surround him with a team, he's able to participate in this while running a 9-figure organization. People like Rachel Peterson, who came from nothing, had no prior money experience of any kind, figured out something that worked on the business side, and then they needed someone they could trust, right? So again, that's what's different. You don't have to know everything to work with us. You don't already have to be sophisticated. We'll work to get you educated like we did with Rachel to where they're confident to be able to move forward. And then Steve, he's a great example of, he names his company, he's the capitalist pig, right? He's here, he wants to make money, he wants to get rich, he wants to help other people do the same. But again, it's making that bridge from the success he's had in business to then creating true freedom through that, right? So that's the type of person that we're looking to work with. So those are just some examples. Our experience and our results, we'll just hit on those really quickly. So Ryan and I are business partners. We've been working together and in the business and investing world for the last 16 plus years. Our companies do over $20 million of annual revenue. And the reason I put that on there is so you guys understand this is an entrepreneur to entrepreneur conversation, right? We get what it takes to run and grow a business. We have teams, we have all the issues and everything that comes with that. Like we get that. And so we're baking that into what we're doing when we're setting this up and working with investors. And then on the investor side, we've raised over $100 million in capital. We've done over 1,700 transactions, and our investor group receives monthly over $900,000 of autopilot income. And that's what we've been able to create inside of our communities. And that's what we're excited to share with you guys and get you in on that with us. Okay. So that's a little bit of our background. What we feel like makes us different is we've already kind of touched on it, is we always lead with education. We always make sure you're understanding what you're doing. This isn't just, come in and just strictly deal focused. It's investor centric. So it's educating you, preparing you, making sure you're making the right decisions, then surrounding you with a team so that then the opportunities can make sense. Okay. So you'll see that as we go through here, but we really feel like that is the difference. So that's our quick background and introduction. Now I want to get into, again, the real problem we're trying to solve. Okay. The problem we're trying to solve is not how do I generate a better rate of return, guys. And it's not how do I invest so I don't lose money. Like if we're trying to solve those problems, man, that's like amateur hour stuff, right? Why we actually invest, you guys. This is one of the most powerful quotes I ever heard from Jeff Bezos. This is talking about Amazon, you guys, like Amazon. That's like the biggest company in the world, right? One day he knows Amazon will fail, but his job is to delay it as long as possible. You guys, as business owners, this is the same thing for you guys. Okay. Your businesses, as much as you love them, as amazing business owners as you are, if Bezos realized Amazon's going to fail one day, so will your businesses, right? And intuitively, we feel this, right? Who's ever looked at their business and been like, this is what they see in the rearview mirror, right? A snot-nosed, whiny brat that's just a problem all the time. Like we get this, okay? Businesses come with problems. That's the definition of a business. We're out to solve problems. So if that's true, why did we start a business in the first place? Right? Like, sure, we want to make a difference. We want to have an impact. All of those things are true. But at the end of the day, if we're doing this and not making money and not making ourselves wealthy in the process, then why are we doing it? Right? So I do want to acknowledge that is a huge element of why we all got into starting a business. But Carlotta, I think you can resonate with this when we then turn to a client and say, okay, cool. What's your plan to take that business that's eventually going to fail and there's a problem in the meantime? How is that thing going to make you wealthy? And most business owners look back at us like this. Carlotta, have you seen this before? Right? Like, I don't really have a plan. I had no plan to begin with. Does that make sense to you, Carlotta? Yes.
Sorry. Yes. Sorry. I was
100%. Do I really look like I have a plan? And Carlotta, when we follow these business owners around inside their business life, is it not like this?
Yep.
It's just total chaos, kind of at all times. That's just the environment we live in, right?
Right.
So however, okay, even though this is the case, we all know that what Warren Buffett said here is true. If we don't figure out a way to make money while we sleep, we're going to work till we die. Now, fortunately, we have a pretty good boss because that boss is us, but none of us want to run our businesses until we die. Okay. But then, and Carlotta, I think you can resonate with it. Go ahead.
I was going to say, I think a lot of business owners, though, they leave that W-2 job so they can make money, more money, but then they get into the same habits as they had in their W-2 job. And they're just spending everything they make, and they're not really investing, and really they don't have a game plan for their wealth. And what happens when, it's like they just create their business and their business supports them until they die, right? Like this is all about creating wealth, and wealth is so much different than just like getting paid to work.
1000%. But when we bring this up, right, sometimes we'll be like, okay, I already have to deal with all my employees and all my vendors and all my clients, and now I have to figure out investments. It's just another thing to pull my hair out about. Okay. To ally that fear for a second, that's not what we're focused on. Okay. So the real problem we're trying to solve, you guys, is we want to help you maximize what we call return on attention, not return on investment. Okay. Your most precious resource as a business owner is not your capital. You can print more money in your business. You can go make money. Okay. What is the most precious resource is your attention. So the problem we're trying to solve is we do want to make you financially free. Okay. But it's not going to be your business. Your business is the bridge. It will allow you to become financially free faster than anything else, but we want to do that while protecting your attention. Okay. So we do things like, guys, I could bring you investment opportunities that would make 5 times what I'm going to show you today, but it wouldn't preserve your return on attention. Therefore, it wouldn't get us what we actually want. Okay. Because what I can't do is bring you an investment that's better than your business. That's the big thing, right? I can bring you investments that will make a lot of money, but if it takes your time and attention, the cost of not running your business or not paying attention to your family or not paying attention to your health or your spirituality or whatever it is that needs attention is not worth the return. Okay. So it's a balance of that. Okay. And then last thing, I promise we'll get to where we want to go. I want to ask you guys this question really quick, because this is going to solve the other part of the problem. What makes someone immortal, right? No one lives forever, but how does our reputation live forever? And consider these 2 people. One is Dan Marino. If you're not familiar with sports, right? One is Dan Marino, one is Tom Brady. Both of them, their entire career led the league in passing, in touchdowns, in completion percentage, all of the things, right? In the regular season. Okay. But there's a difference between these 2 people's legacy. Okay. If you look up greatest quarterbacks of all time, Tom Brady's at the top of the list and Dan Marino is an asterisk. And what's the difference? Now it's in the pictures. Okay. The difference between somebody that leaves a legacy and somebody who was just really good for a little while, but relegated to being an asterisk, is Tom Brady won championships. Okay. Both of these players are going to retire terrible at football, right? Because they will not quit until they're forced to leave, right? Even Super Bowl winning quarterbacks, very few can ever leave at the top of the game. They're too competitive and they're going to get old or they're going to get injured and they're going to end up being terrible at football. However, Tom Brady will always be remembered as one of the greats because once you're a champion, you're always a champion. Okay. So in the business world, I want to ask that same question. Okay. Whoop. I gave it away. I want to ask the same question. Okay. As a business owner, what is the equivalent of our championship ring? What is the thing that if we achieve while we're running a business will make it so that no matter how we exit, no matter what happens to our business, we're still a champion? Because isn't that what we really want anyway? Right? And we've known business owners that have grown massive top line revenue and then lost everything, or had massive, huge teams and large scale across continents and still lost everything. Even very, very, very profitable companies, and they've still lost everything, right? And back to the Amazon quote, if we know we're going to exit the business world terrible and we're going to get cut someday, we're going to get fired at someday, right? What is our championship ring? Okay. And the way we view things is cash flow from investments that we own, but are not our business. That's our ring. Because if we can take our business success, our revenue, our teams, our profitability, and convert it to cash flow, now our business can do whatever it's going to do, yet we still remain a champion. Does that make sense? And I hope that's what you guys are looking for, right? It's not about making more money. It's not about timing things correctly. It's not about being early into opportunities. It's not about that. It's about becoming a champion. Because guys, ultimately, at the end of the day, cash flow is different than profit. Okay. Profit is fun. I love it. And I want to grow more of it. And I have businesses, and you should acquire more businesses. You should always invest in your business. But at the end of the day, cash flow is freedom. And like I said, that comes from assets we own independently from our business. That's the bridge. Okay. So the rules that we're going to follow today and the rules that our company Altitude Capital lives by is, first and foremost, we're looking for safety of capital. Because the last thing I want to do, guys, Carlotta, you can resonate with this. The money in your wallet, the money that you have to invest with us is the most expensive money in your life, because you had to go out and create gross revenue, and then you had to pay operating costs on it, right? You had to pay your team, and you had to pay rent on your building. You had to do all those things. Then you had to pay taxes on it. Hopefully not very much, because Carlotta, right? Then you had to spend it on your lifestyle. And then what's left over is what we can invest with. And if we lose that, guess what we have to do? We have to go all the way to the beginning and go through that entire process to make more of it. That's what we want to avoid. So safety of capital is first and foremost. Second is cash flow. We want a ring, right? And then third, we want to make sure that we can do this without giving up our most precious resource. Is that cool? Does that resonate with everybody? Like, if you want to go do stuff that's more exciting, then you might be on the wrong webinar. But this is what we're pursuing and what we're after. Cool? All right.
Can you define cash flow for them? Because I think people get confused of like your personal cash flow, your business cash flow. How does that go together? And what do you really need to be looking at when you're looking? Because which you just talked about on your podcast today, like Dave Ramsey, it's like, don't spend, and save your way to $1 million or whatever. Yep. And then business owners, they go way off the other side. They don't even listen to Dave Ramsey because they get ingrained to spend in their business, and then they forget to save personally and invest. So go through that and talk about it.
So perfect. And you're hitting on this. I could have spent more time here. So cash flow is different than profit, right? And cash flow, if you're not a business owner, if you're W-2, cash flow is different than a paycheck. Yes, cash flows in and flows out, but it's a different concept, right? Because for my W-2, I have to trade time and effort for it. For my profit in my business, I have to trade some time, but also expertise and risk, right? Even if I don't spend all of my time in my business, if I disappeared to the mountains for 2 years to go get enlightened or something and came back, your business probably isn't where it is now. You still have to move that business forward. Okay. That's profit. Okay. And it puts money in our pocket and it flows and it feels the same, but it's not. Okay. Cash flow is dollars that recurred. They come into my life on a regular basis, but they come from assets that I own instead of my time, effort, and energy to move it forward. So an asset with inherent value creates the cash flow on a regular basis. Now, some people say, well, my stock market thing cash flows. It doesn't. If I have to buy and sell to create the cash flow, that's not the same thing, because it goes back to time, effort, energy, expertise. Okay. But this is something where I can simultaneously hold the asset and it will write me a check on a regular basis. That's what creates us freedom. Okay. Rather than a business that cuts us a check on a regular basis, because we have all the volatility and variability inherent inside of a business. Is that a good enough explanation? Have I missed anything there, Carlotta? Did I miss anything there? Are we good?
Nope, that's good. That's good.
Okay. So that's a huge, huge point. Now, if I ever have a choice between these, right, I want to make sure you're generating enough profit before we come and have the cash flow conversation. Okay. But at some point, we've got to cross this bridge. And that's what we're all about here. Okay. And we want to do it in a way that preserves our capital, again, creates that cash flow and preserves our attention. Okay. Sweet. All right. Good clarification. Thank you, Carlotta. So now let's talk about where the right opportunities are. Where are these found? What types of things work? Okay. So how do we create the streams of money, collateralized cash flowing real estate on autopilot? Okay. I don't know what you think of when I say the word real estate, but this to me solves the argument once and for all, because 90% of all self-made millionaires have one investment in common, just one. And that is what we call collateralized cash flowing real estate running on autopilot. Okay. It is the single most time-tested, proven way to put our wealth to work. Okay. Because that's really what we're doing. We're creating the wealth in our businesses, but we're putting it to work through real estate. And I can already hear some of you saying, oh, but Brad, I know someone that lost money in real estate, or I lost money in real estate, or this feels risky. Okay. This is one of my mentors from way back early on. His name's Mark Ford. He was worth about $200 million plus at the time I was mentoring with him. And he loved to say this. He's like, if you lost money in real estate, it's because you did exactly the wrong thing. Real estate investing, if you do it the right way, is the easiest way to build wealth. So that's what we're going to talk about, is the right way to do it that preserves our capital, creates cash flow, and maintains our return on attention. That's how we're not going to lose. Okay. And there's two different approaches that we can take. So I'm going to work you through kind of a thought exercise here to get us down to understand why we're doing, because I could have just come in and said, here are 3 ways to invest with us, give us your money, right? But I wanted to back up and understand the problem, understand why we're getting here, and work our way down so we know why we're doing these, and then we don't get distracted by everything else that's possible, okay? So there's 2 general approaches to real estate. We can own real estate, or we can control real estate, okay? On the ownership side, Carlotta's husband has seen that side of it, right? That's what he does, right? He's involved in it day to day. And no matter how we do it, if we own the real estate, that's like owning a separate business. We can make it a little less involved than swinging a hammer every day, but we're running another business, okay? On the control side of it, we're able to get real estate-like returns without actually doing the real estate. So if you ask yourself the question, well, should I own or control? Well, just think, do you want another business, right? And count that, like, if you have 1, 2, or 10 businesses already, we probably don't want another one, okay? However, there are people that like or enjoy real estate or have enough capacity or enough time that they could decide to start another business and run real estate in it. Wonderful, okay? But understand that's the decision you're making. And if starting another business is something you've never done before and you don't have a background in, kind of turns your stomach, well, then you shouldn't own it. You should just control it. And it's interesting. I've actually shifted a lot of my investing over the last 10 years. I started out owning real estate because my businesses weren't as successful as they are now. And I had some time and I actually thought I enjoyed it. So I spent time building up owning, and I did that through turnkey real estate. And we have a turnkey real estate arm of what we do. We do over 200 homes a year and sell another couple hundred on top of that. We do that. But as my business has become more successful, I've actually transitioned mostly out of owning it over to controlling it, because I want to focus on the businesses that I really love and then get my time back. Okay. So here today, we're just going to focus on the control side. And there's 3 main ways we can control real estate without having to do any of it. Okay. And we put these into 3 different buckets. One we call asset-backed lending, one we call value add, and a third we call ground up. Okay. And this will help us identify when somebody brings us an opportunity, it'll help us identify what's going on, how I'm participating, what types of returns I should expect, and whether it's a good fit for me or not. Okay. Because so many people are like, here's an investment and here's a rate of return, you should do it. There's so much more going on. And that's what we're going to unpack and go through. So this is where get ready to unmute and ask questions or type in the comments, because we're going to now break all of this down. Okay. So we're going to start with asset-backed lending. Okay. Think about asset-backed lending kind of like you're going to become a bank. Okay. And think about your house if you have a mortgage on it, right? the house that you have a mortgage on, who's responsible for fixing it up and cutting the grass and paying the utility bills and doing all of that? You are, because you're the home owner, right? Okay. But who controls the property? The bank does, right? So all decisions have to go through the bank. If you want to sell it, you got to get the bank's permission because they've got to get paid back first. If you want to make huge material changes to the property, you have to run that past the bank because they control it. But since they control it, you can't say, well, bank, you have to cut the grass, right? They're not going to do that because they shift ownership burden to you, but they stay in control of the property. Okay. So you think about, so we can do that inside of real estate. Okay. And just like a bank, we want to pay attention to the same things. So keys to making this type of deal work is we have to pay attention to LTV or loan to value. Okay. Because a bank doesn't let you borrow 100% of the value of a house. Why? It's dangerous and risky. Okay. So they manage the LTV to stay protected. And we would want to make sure that where we lend does the same thing. Okay. Another one is deal diversity. We don't want to lend all of our money to one person on one deal, because if that goes bad, we lose everything. So we've got to gain some diversity and have multiple deals, not diversity in real estate and stocks and bonds and all of that. That's not really what we're talking about, but we're talking about several different opportunities so that we can spread a risk across multiple people. Okay. The third one that's really important is you've got to understand the operator. Somebody is running this business that is real estate that's then going to pay you. And you've got to understand that there's got to be multiple exits. What if something doesn't go to plan? How are you still going to get paid? And you've got to have confidence that the operator has multiple strategies to still get you paid. Okay. And then last, you want to understand the skin in the game that the borrower has. Okay. Because like me with my house, I have equity in it and I have my credit score on the line. So I have skin in the game to make sure that I do what's necessary to get the bank paid. We want to make sure the person we're lending to has skin in the game with the deal as well. Okay. So that's very important. We got to understand those. So those are kind of some general ways to think about it. I'll explain specifics here in just a second. So pros to asset-backed lending. We generally are able to create cash flow immediately. That's a big benefit inside of real estate. And then it's generally very, very stable, meaning we get the same payment every month, every quarter, however it's structured. It's very, very, think about your mortgage payment. Doesn't matter what's going in the stock market, you're paying the same amount. Doesn't matter even what goes on in the real estate market, you're still making the same payment, right? So we gain stability, okay? But what we give up, because we're only lending on it, again, think about the bank. If I borrow from the bank when my house is worth $500,000 and it goes to $700,000, I don't have to share that with the bank, right? So the downside to this is we don't get any equity upside typically, okay? We also don't have any leverage because we're the leverage, right? We're putting the money into it. So we don't gain leverage. And then we have very limited tax benefits. This income is usually better than active income because you don't have employment taxes and some of that stuff to deal with. However, it's very hard to make tax free because it's difficult to get write-offs against its portfolio income. So we have some limited tax benefits there. And then the other downside to this is the investments are generally short in time frame, meaning we lend for 6 months or 12 months or 18 months, maybe 24 months. And then we have to solve the problem again of, great, I got my principal back, but now I've got to redeploy it, right? So we've got shorter time horizons, and that's a downside because deploying capital requires our time. That make sense? Okay, so that's kind of the pros and cons on it. So let me walk you through a couple of deals. Okay, so this is an example of a fund that we helped raise capital for. Okay, a fund is an awesome way to do this because you have diversity built in. There are, by definition, multiple investments inside of there. But as you can see here, we've got guaranteed payments. So we get a K1 and we get guaranteed payments. Okay, and you can see the size of this. That's the other great thing about lending is we can deploy a lot of money. Like we can write 7-figure checks if we want to. It's because this one was this was 25 million that we could have put into this. So we could write lots, we could deploy a lot of capital. That's one of the big benefits. Okay. And we're collateralized. We're in a first lien position. And then you can see here, maximum LTV, no individual deal will have an LTV above 70. So that gives us a lot of security to it. Our target is 50 to 70, 16 to 18 months. And then we've got some additional capital or additional security backing our loan. So this is kind of what we would look at and understand, okay, what's our LTV? What's our collateral position? What's our time frame? And how are we being paid? So this would be an example of, I could write a $100,000 check, a $500,000 check, $1 million check. And in this case, it doesn't state the interest rate here, but anywhere from 8 to maybe 12%. And we could start collecting cash flow on it immediately. That would be an example. Another example, this is a specific deal that we raised money on. So this was a hotel that they wanted to renovate, but they couldn't go to a bank because the bank wanted to see they wanted to lend on the asset as is. Typically banks lend on assets as is, not what you think they're going to be. So they needed bridge financing to come in, update the hotel, raise rental rates, and then refinance back out. So we raised $2.7 million for them. The LTV was 63% on the entire deal. So the operator's skin in the game, they had 40% equity, and this was their bread and butter business. So we were lending to a business owner who this is how he fed his family. So he had high skin in the game to make this work. And then they paid us 1% a month or 12% a year. But it was a 12-month loan while they renovated. And then once the renovation was done, they could take the finished asset to the bank, get cheaper financing than us, and we exited the deal. Does that kind of conceptually make sense? So these are the types of deals that we're able to vet and find and source. And then you don't have to spend time negotiating all of this. So we put all the terms together, and then we go to our capital partners and say, who does this make sense for? Who wants income immediately? Who wants a short-term obligation? And who wants cash flow immediately? They raise their hand, we fund the deal, and we move on with it. Make sense? Does anyone have questions around asset-backed lending?
Wouldn't you say this is more stable than the stock market, because you don't know what the stock market's going to hold? These people you've got, 37% equity, that you're going to get paid or they're going to go under. I mean, wouldn't you, is that when someone's thinking, okay, I could go invest in the stock market, or I can invest and help a business owner and get a 12% return, and it's a short term, like, I'm thinking this is more along the lines of almost like a CD at the bank. Whenever CD rates are like 0.0001, this is kind of more along those lines.
That's exactly right. And guys, think about that, because people think, oh, this is risky. Well, guys, what's backing your stock market investing? Nothing, right? Equity in a company that could go out of business tomorrow, right? And really, it's actually propped up just by consumer sentiment, right? What they feel like is going to be going on, right? So you don't really have a backing, and this is creating income. So in the stock market, the only way I actually get paid is if I exit, right? I get paid in price increases, where this 12% is cash in my pocket, and then my principal is still protected by the real estate itself. And then from a volatility standpoint, this real estate would have to fall 40% before I couldn't get my money back. And then even if it did, this asset is still creating cash flow that can pay me in the meantime, right? So we don't get that inside of a stock market investment, or even inside of a bond investment or anything like that. So we can create high amounts of income, highly collateralized over those shorter time windows, right? And people ask all the time, well, why would they pay you 12% when they could borrow from a bank at 4%? Well, they can't borrow from a bank at 4% because the bank wants a finished asset, right? So they're going to come in for bridge financing. They're going to go to a group like us and say, I will gladly pay 12%, because on the back end, I'll have a brand new renovated hotel. We'll be able to raise all of our rents, and then I can go secure long-term financing with a bank, right? So we're just stepping in the meantime to provide an operator, somebody, again, with high skin in the game, a bridge to their solution that they need. So that's exactly how I would think about it. A CD, a guaranteed secured source of income that is backed by a real asset in this case. And we can do it. A fund typically will give you a longer time frame. The loan maturities here are 6 to 18 months, but we have funds that'll take your money for 3 years. And then their job is to find all of the different investments, but they're still going to pay you the 8, 10, or 12% return, kind of however it's structured, but it's their job to turn over the investments. Or you could do an individual deal like this, and then the principal would be returned to you, and then you'd have to find a way to then redeploy it. So there's kind of 2 options to go depending on, again, how involved you want to be. Cool. Sweet. Okay. So anyone got questions on asset-backed lending? If so, ask them in the comments, or we'll
What
also
if
have Q&A at the
you,
end.
I'll ask, because I know some of our clients would like asset-backed lending. How can you find lenders that will, from the flip side, if you were an investor? So if someone here, because I know some of our clients do this, how do those people find you?
So
Or how do y'all get matched?
Yeah. So our job, that's what we do at Altitude Capital, is we have relationships with the operators that aggregate these loans, right? So we bring the capital, but we've got a couple of different groups that their entire business model is finding these people that need the bridge loans, right? So they're in the business of, they're finding it, they're doing all the due diligence, they're doing all the legal paper. So their team they have an acquisition team, similar to like, how does we have a turnkey company in St. Louis where we flip 200 homes a year. Well, how in the world do we do that? Well, we have an acquisitions team where we scour and find, for sale by owners or rundown properties, and where we get all of those and we go. So we have an entire acquisitions team. So do they. So they've got an acquisition team where they're out looking for the distressed owners that need this support. They've got a due diligence team where they do a market analysis that, is this even a good, like afterwards, can they actually even raise the rents and all of that? And then they have an operations team that works hand in glove with the team. So they're managing the progress of the project to make sure that it stays on track. And they're there to actually open up doors for these people to make sure that they can get the project moving, they can get investors paid, and we can exit cleanly. So we have a direct relationship with groups that go find the deals, and then we bring the capital side to it, because they can't, like, everybody needs to specialize, right? So they specialize on finding it. We specialize on educating or working with investors and making the match. There are people, we've got some clients that this is what they do for their day job. They find their own deals, right? But that's back to the more to where you have to, because it's all about deal flow, right? And if I don't want to spend my time looking for deal flow, we plug into either a fund or a group that brings these investments to us. Did that answer the question?
Yes, thank you.
Yeah, super cool. Okay, so that's asset-backed lending, and we have these types of opportunities all the time that we match up investors to. Okay, the second time is what we call a value add syndication. Okay, think about this like flipping a house, right? HGTV. You find a rundown house, you put $100,000 into it, make it look amazing, and then it's worth more than the amount of money it took to fix it up. Okay. But instead of fixing a house that's maybe a couple $100,000, we're flipping hotels, or we're flipping storage units, or we're flipping office buildings, right? So these are now 30 years old and they need to be updated. And that requires, instead of a couple $100,000, it requires a couple $1 million or 10 or $20 million to be able to do that. And just like the person who wants to lend to that wants to borrow, there are times where a group will come in and buy the asset. So a lot of times, so this Super 8 deal, the owner wanted to keep the business. So they didn't want to give us equity. So they just gave us an interest rate. On a value add, we'll come in and buy the entire project. So now the owner is exiting, we're buying it, and now we're taking an equity position in the deal. So we're raising money to buy the property and raising money to do all the renovation that's necessary. And then the operator, and this is who we partner with, people that find these deals, negotiate the sale, and manage the entire project. Then on the back end, we can either sell the project or manage it. But typically, we don't place long-term management here, right? Again, it's hedgehog principle. It's what are you good at? They're good at finding and renovating and then handing it off to a long-term operator. So think about this like fix and flip, but it takes about 3 to 5 years, maybe 7 years to execute this. So we have a longer time frame than lending. We have some equity upside with it, but it's not gonna stay in our hands for the next 20 years. That's kind of the difference. Okay. And the things that we want to look at here is operator experience is number one. How many times have they done this? How many deals did they do? And have they done it in hot markets and cold markets, right? Have they gone through economic cycles to where their business model still works through all of them? That's number one. Okay. Number two is you've got to understand deal structure. This is where we spend a lot of time teaching people what to look for, because just because it's a hotel renovation that on paper looks the same, how it's set up, where investors are positioned matters immensely. Okay. And then the third principle that we teach investors to be able to pay attention to is what's called cake versus icing. Okay. So cake versus icing, meaning are they selling icing or is there actually a cake underneath there? Okay. And a lot of times, because we're trying to flip, think about HGTV in like 2006, right? Real estate was nothing but up. People were paying crazy valuations. It was easy to take a property, flip it, and sell it, right? We're kind of in that same market here, right? People are paying crazy valuations for stuff. That's more of you're selling icing, right? Versus what's the underlying asset really worth in a, if something were correct. Because if we lock into a 3 or 5 or 7 year deal, okay, and the market changes, the icing melts away and we're only left with the cake. So we got to be careful of, we can't just look at a spreadsheet and say, well, it's a 28% rate of return. We got to be able to understand how much of that return is coming from cash flow, how much is coming from leverage, how much is coming from tax savings, and how much is coming from the projected market value. And right now, most of the returns are weighted toward market value and not which is icing instead of the cake. So that's what we teach investors, how to spot and understand that. And we heavily vet deals that are cake, not icing. Make sense? Kind of conceptually? Okay. So that's the education you need to know to be able to participate in these. The pros to this is, again, they're cash flow focused. We do generally have equity upside because we're coming in as equity, silent, passive partners, but we have equity to it. We've got some amount of leverage, although it's a little bit limited because typically we're bringing all of the acquisition capital to the table. And then there's a leverage event to get us out on the back end. And then we do have some tax benefits. They can pass through some of the depreciation to us as the investors on it. And we can offset at least some of our cash flow gains through that. So there's some really good benefits there. The cons are we have got about a 5 to 7 year investment horizon. And usually the first year or two, we don't have any cash flow coming in because it's all going into getting the property up to speed. Okay. And then, like I mentioned, we're subject to interest rates and market variation and all of those things because we've got a longer time horizon to it. We're not just getting a guaranteed payment. We're taking on a little bit of that potential. Our return will be affected by what the valuation is. Does that all make sense? Kind of conceptually? So that's kind of pros and cons to it. So an example of a deal like this is, so this was a deal us and investors participated in. It's in Park City, which is here in Utah. So this is an existing building, right? And it needed to just be updated. So we bought the building, paid $6.9 million for the building and the renovations. Okay. So we converted a building from what its use prior to make it condos and lofts, and then some event space area. So that's what it became. Our LTV was amazing, right? And on these types of deals, that's generally the security you're going to get is with a 46% LTV. We had an expected time frame of 12 months, and then investors got a 15% rate of return plus an equity position as long as the operator held it. And they have a defined exit time frame, but they get to hold on to a little bit of equity. And so the way this works is after renovations are done, we go in and refinance it, pay investors back, but then they got to hold on to an equity piece until we sold it down the road. Okay. And those exit events are usually 5 to 7 years, something like that. So we get to get our money back and still have an equity piece and a little bit of cash flow while we're going. So that's kind of how those deals are structured. Okay. Carlotta, what am I missing? What can I clarify? Or does anyone else have questions on a value add syndication?
Okay. So this was a 12-month, they got their, what they put in back in 12 months, and then they got 15%. This is this seems like a lot better than the other one because the rate's higher, but I'm assuming that there was a chance it wouldn't be 15% if the market went down.
Right. So on this one happened to be they guaranteed the 15%, but yes, it was backed by the market valuation, right?
Okay.
However, the big variation on this is 12 months, right? If it took 15 months to renovate, it took 15 months. If it took 24 months, it took 24 months, right? Because you're now participating with it rather than just collecting the interest, right?
So is it still 15% a year interest, but whatever, however long it takes, it's just longer, or is it 15% set interest for however long it takes?
It's generally a fixed amount of interest that is 15%, right? And then that's why you carry the equity option to where if it goes longer, well, you're getting paid on the equity upside with it. So if you put in $100,000, you get like 15,000 in interest, kind of no matter how long it takes, but then you've got that equity upside to it as well. And the 15% usually isn't paid monthly or quarterly. It's usually accrued and paid at the end, right? Because there are no, real operations going. And that's where we take a little bit of risk because if the market tanks and everything changes, they might not have the 15%, right? And we may have to be forced to get all of our return out of the equity side of it. So we've just got variation in it. And this is why the deal and feasibility and the operator is so important to a deal like this. And that's why this isn't a perfect deal for everybody, because I may just want that, even though the rate's lower, I may just want the cash flow, right? And not be in a position where I partner on the risk side of it. Make sense?
Yeah, but the tax benefits on this one you should have gotten some cost segregation, I'm assuming.
Yep.
So that's what you're looking at, guys, when you're looking at these deals, that you're not going in. Like they said, they have single family houses if that's the route you want to go, and that gives you a lot more depreciation and it gives you usable depreciation. But this gives you the offset against what's coming back in. So it's tax-free wealth, but it's not going to offset the money from your business that you're running, like Airbnb does. We talk about Airbnb, and Airbnb is a lot of work, but it gives you that cost segregation that you can offset against your other active income. This, on the other hand, is really long-term plan. This is what your long-term plan is. That's why we want you guys to have these options, because once you start doing a lot of these, they offset each other. You group them together, and you get cost seg over here for this one. You don't get income on it for a couple of years, but then you've got this other one that you invested in a couple of years ago that's now coming due. So this is more of a cycle, and this is the cycle you want to get in as you grow, this is your long-term plan.
Yeah. So think about having 3 of these deals stacked, right? When the first one, we get some built up depreciation benefits. The second one, we get some more. The first one starts to produce. We use the second one to offset the first one. And then we go to the third one, we use that to offset the second one. And we sort of daisy chain this together to where those tax benefits help us going forward.
Agreed.
Make sense?
Agreed. Yep. Because we don't want to, Brad, you said you've kind of gotten out of the ownership of the houses. Do you see yourself paying a lot more tax because you did that? Or have you daisy chained these together enough where you're really just have a lot of tax-free wealth?
So I'm very aware that that's where I'm headed, and I'll either come back to own some to maintain tax benefits, or make sure that I've daisy chained enough of these together to where we can cost seg advance that forward. And I even still have some just lending because I have money that I have a plan for sooner, but I want to generate a yield on now, and I'm just okay paying tax on that, right? So it is, and this is why a plan in education is so important. It's not just this deal and that deal. I kind of think about it like when you go to the grocery store, you don't just randomly put stuff in your cart. You've got a list and a recipe that you're trying to follow, and you buy the right ingredients, right? So the key to this, between own and control, and then each element of control, is making a recipe for you to get what your plan says that you need, right? So my plan is saying I need less own, and I'm okay with more control, and I may pay a little tax on that because of it, but I'm buying back my time, right, on that. Or really, I'm able to deploy a lot more capital than I can deploy through the own side, because that's the other challenge of owning it, is it's a small straw to push capital through. Yep. So it really ends up being a mix of this, to where we should be able to still, I'm okay as long as I'm in high single digits, low double digit taxes. That's enough for me. I'm good there, right? And then I'd rather move on to more important stuff.
Yeah. I think that's where, I'm the same way. As long as I'm in single digit, I'm good.
Yeah.
You start putting me in a 25%, and some of our clients are in that 40 to 50% place because they can't do enough tax strategy. They're making money way too fast to do enough strategy. And so you've got to start building a plan like this, because you can't go buy 500 houses. And, so we've started doing some charitable trusts or charitable, donations and stuff like that. But this is really, and there's several on here right now that have this problem. So
yep.
They need to be focused on, I think, this.
Yeah. So somebody in that higher tax bracket, we're probably not going to focus on asset-backed lending initially. We're going to come in and get some of these and get this pattern started so that the dollars they have paid taxes already are now protected going forward. And maybe we even do a little bit of owned up front as well, because then we can get some massive cost seg going that we can use against these, right? So there's going to be a blend here, but this allows us, the other really great part about this, similar to asset-backed lending, is I can write $100,000, $250,000, $500,000 checks and get it working, right? Where in single family, owned real estate, that's a challenge. Okay. And I don't have to spend any time. I don't have to find deals. I don't have to talk to operators. I am a completely silent partner, yet I still get those benefits passed through. Cool. So that's how a value add syndication works. The last one we'll cover, and then we can even do some more Q&A here, is what we call ground up. So it's the same idea as a value add syndication, meaning the investors are bringing the capital and an operator is executing on the deal. But instead of a fix and flip, think about this like a startup, like a Silicon Valley startup, right? We're going to put money into something that doesn't exist. It's an idea on paper. It's a set of plans. And then because we're ground floor investors, we have all of the upside left, right? Like think about the early investors of PayPal, right? They killed it and then they sold the company public and the public made almost nothing on it, right? The people that really make money in the stock market are the people who take companies public. They go from the ground up, right? Who would have loved to be a ground floor investor in any of the alphabet companies that we think about, right? That's what we really want, right? That's kind of what we get here. Because we're going ground floor, we get the most back end out of it. So again, the keys here are, again, operator experience is huge. Feasibility is a big one here. Understanding, well, if this project doesn't exist, should it exist, right? Like, can the market absorb it? Can we actually get those? So feasibility studies are big here. But, a fix and flip, if it already exists, it should already exist because it's there, right? And we're just going to make it better. Where here, feasibility is much more important. Again, deal structure, understanding how this can be put and where you are in line and how this is set is very important. And then the other thing is timeframes. It takes longer to build something ground up than it does to rehab something that already exists. So we've got to be very aware of what our realistic timeframes look like. Okay. So those are the things to be educated on, that we'd work with investors to educate them on. Pros to this, again, it's a cash flow focused thing. We've got lots of equity upside. We generally have lots of leverage here because we can now go get construction loans. So a lot of times investors will buy the land and will borrow to then build it. And so now we get leveraged equity into a deal like this. Whereas a syndicated one, typically all of the money is raised from investors, so our leverage is a little bit lower. And with more leverage comes exponential tax benefits, right? Because if we put $1 in, but we get $5 worth of value that we can depreciate, now we're getting, in some of these cases, we can get more than $1 of tax benefit for every dollar we invest because of the leverage that we're able to add to these and advance depreciate. So bigger tax benefits here. And then these syndicators, these opportunities are generally ones where we can stay in for as long as we want, right? And that's this is why I love ground up, is I can make this investment. I have to wait a little bit longer, but then I could own this for 10, 15, 20 years before then someone needs to come in 20 years down the road and renovate and fix and flip it, right? Because eventually this will wear out and need to be repaired, but I get to extract all that value for 15, 20, 25 years. So this is what builds long-term portfolio stability, is being willing to get in on the ground floor. Does that make sense? Okay. Downside to it, it's more of like a 3 to 5 year stabilization period instead of 12 to 18 months in a fix and flip or immediate income in a lending opportunity. Okay. And then we do still have some subjectivity to market valuation. However, as long as we're stacking our returns on the cash flow, it's going to create, we're not looking to harvest the equity because we're not looking to sell, right? So it's usually less than a fix and flip. However, we have equity ownership in something that's going to vary. Okay. So that's kind of pros and cons on it. So here's an example. So this is it's Bear River Storage. Is a storage unit we built from the ground up. So we bought the land, we partnered with an operator, we put all the plans together, we built it, and then we filled it, and then we got long-term financing on it. And here's kind of some ideas of how this works. We put 6.5 million into it, but it appraised at 10, right? So right when it's constructed, we almost double our money, right? Inside the construction time period. Okay. And then this thing kicks off $300,000 in cash flow per month. It's insanity, right? Because we have all of that built-in equity, right? It's a $10 million asset that we only paid 6.5 million for. Okay. And then as you can see, our projected IRRs here are quite a bit higher. Now here, we don't get guaranteed income like we do in the other two, right? We're back-end equity investors with this, but if we're willing to put in time, these are kind of the upsides. And this doesn't even include the fact that we got to depreciate the heck out of this, right? And bring a lot of that forward and really utilize a lot of what goes on here. So that's an example of a ground up. And this could be a storage unit. It could be a hotel. Like we've done ground up hotels. We did a ground up golf course before. But that's kind of the idea is, if we're willing to take on the time frame risk, it's like I said, it's like getting in on the ground floor. It takes years for a company like Facebook to become Facebook, but we got in on the ground floor and we get all of that upside. We're able to capture that. Okay. Other benefits similar to the others, we can write large checks for it, 100,000, 250,000, 500,000, whatever we're able and comfortable to do. So we deploy a lot of capital into it. But what I love about these is the leverage and tax benefits on these are off the charts. Really, really, really powerful when we can get into deals like this. And this is one of the areas we specialize heavily in, because it just lines up with what we're trying to build is that long-term asset portfolio. So Carlotta, what questions? You've been awesome.
Storage units, like I don't care if you're buying through Brad or on your own, storage units have the highest cost segregation available for anything that I've seen. So definitely a great source for you to get tax strategy from return on your money, because like you said, you put $1 in, like sometimes you put, $200,000 in investment in, and you can get a $200,000 cost seg or $250 cost seg the first year. And that's 30%
return year just off of that.
Yeah.
Yep.
It's amazing. So, guys, what questions do you have? We want to make sure that we're looking at your time. So let us know what questions you have in the chat, because I know that we only
time went fast, didn't it?
I know we can talk forever about this kind of stuff, but I want to make sure that you guys, I want Brad to kind of tell you what to do now if you want in.
Let me get to that really quick. So those that need to bounce can bounce, and then we can do questions later. This is just kind of a quick summary of pros and cons. We went through all this already. Here's kind of what you can expect rate of return wise, right? Asset-backed lending is about 8 to 12. Syndication is maybe 12 to 18. Ground up is 18 plus. So that kind of puts rate of returns into perspective to balance out the risk that you have to take for it. Because like you said, they're all different. So if you're ready and you're just like, tell me how to do this. Okay, let me explain what we do and how we get paid so everybody's clear on that, and then what it looks like to move forward. So again, our job is to match qualified investors with quality opportunities, okay? What we do, our role is to partner with experienced operators, source exclusive deals, and a lot of times we either have sole access or at least first rights to it, meaning coming through us, we get the deal to you first before it goes anywhere else. We work to structure the deals and make them investor-centric instead of operator-centric. So we really work to line that up. We perform the preliminary due diligence, and then we become a single point of contact. So we're an opportunity where you can invest in all 3 types of these, but only have to talk to us instead of have to go find 6 or 8 or 10 operators to talk to, right? So we kind of provide that. How we get paid, no fees, no overrides, no hanky panky here. So we either take equity that is subordinate to investors, meaning we're an equity partner along with you, but we get paid second, okay? Or we've created a strategic partnership with the operator where we're getting paid from their profits, not the investor split. So a lot of other like our registered investment advisors that raise money for these types of deals, they're actually taking a portion of your cut, where what we're doing is we're handing you a direct relationship. You're not investing through us, you're directly investing, and then we've got a relationship on the back end with the strategic partners that they're paying us. Okay. So that's very key. This is structured very differently than most people that raise money. Most are taking the money out of your pocket first, not out of the deal on the back end. So we put ourselves last to get paid because it's your money that's coming in. Okay. So next steps, you can either continue to explore with us, or if you're ready to invest, you can follow up to do that. So really quick, if you go to altitudelife.com/capital, the first step would be to just opt into our newsletter, and we'll send you deals, we'll send you analysis, we'll send you investor updates. It's kind of like paper trading. You can see the deals and you can see how they perform, and you can raise your education. So if this is all totally new to you, you should just opt in and hang out and see the deals over the next little while. That's great. All of you are totally welcome to do that with us. Okay. So it's altitudelife.com/capital. For those that are ready to invest, the very next page will be, if you're ready, fill out our investor form. We need to get some information about you and how this works. And then we could set up a discovery call and take you through creating a game plan and then matching you with the right opportunity or the right blend of opportunities and working with you to get your capital deployed. Okay. So either way, we'd love to have all of you on there so we can continue helping you understand these. And then those that got money, burning a hole in their pocket that want this out right now, we do have active deals in all of these categories that we could work to place, pretty much immediately. So again, altitudelife.com/capital. All you gotta do is opt in and you can get all that info. Super great. Okay, Carlotta, what questions for those?
So TJ said, in the syndication deals with many investors, how does the individual get the tax or cost segregation benefits from such a big deal? They just come through. Anybody that does a big syndication like this will do a cost segregation because that they know that's why the person's investing, and it comes through on your K1. So they do all of that work for you.
So that's the beauty of controlling the real estate, right? And when we talked about deal structure, not all deals pass depreciation through. It can be structured in a way that it doesn't, right? It can be structured in a way that you don't get the leverage benefits from it either. So we want to work to make sure we look like we own it, but we're only controlling it, meaning no one's calling us. We're not making decisions. We're not involved in the day-to-day, but we still are structured in the way that we get all of those benefits. Yep. So you're one of many that owns it, but everybody, like the storage unit deal, for example, when you invested, you ended up owning 2% or 5% or 10%, depending on how much you invested of that storage unit. So you had that type of control, but an operator was taking care of all the work.
Yep. Awesome. Will our TWS help us pick which path to go down? So far, we have just talked about own path.
Great. So this is somebody that's already inside of the education side of our community. I would actually still opt in through here. Our TWSs are more preliminary. Ryan and I will step in and help do some strategy to this level. So generally, if you've come through our TWS, eventually you would have got raised to us, or you can come through this avenue, and Ryan and I will get in, or we'll work to build a game plan in conjunction with the TWS to make this happen. So I would still say, come in and fill out and kind of raise your hand and say, I'm interested in these specific types of deals, and then we can get working with you.
So just so y'all know, because I want to point this out, TJ is in Brad's circle, but he is not in his $10,000 program, and he has not even been offered these. So I want you guys to just know how amazing this is, that they are bringing this to us and letting us invest with them, because they invest for a lot of our friends. They do amazing, and we want you guys just so you know, Carlotta Thompson does not make any money off of this. I just know that when I asked you guys what you wanted from us, you wanted investments, you wanted tax returns, and you wanted tax strategy. So I'm just trying to serve you guys with everything I can. So
hey guys, I'll even back that up. I tried to pay Carlotta on this and then charge you guys to make that work. And she's like, no, just if you'll give it to them, I'm good just making the introduction. And TJ, that's the real answer. Our TWS is, we don't have them talk about this because you have to be in our much higher level programs for us to bring this type of investment across. So they're not going to bring it. It's only part of what generally would be the higher level program. That's the right answer. Yep.
So I'm just so excited for you to be here. I can't wait till you come back and talk about the next thing. But guys, this is amazing. And I hope this is what you guys wanted. If you want more of this, if you want more of maybe Brad bringing the deals that they're doing, I'm not sure. What do you guys want from us? Let us know and we will make it happen. But this is who we're working with investments, because it is the real estate. It is what you guys need. if you are wanting some single family homes and to go down that route, I know Brad has that as well. I know
we'll come back on and talk about the own side. Carla, we talked about that. We'll come back and talk about some of the insurance strategies that we do. They're also super ninja and very fun to talk about. But yeah, this was more the immediate, if I've got cash and I've been feeling the pressure and I want to go, we just took all the restraints off and said, here's how we make it happen. We'll sit down with you. We'll make the introductions and we'll make it happen and we can go, right? And then we'll come back in and we'll talk about more of the specifics of these. We'll talk about other opportunities and some other things as well. But yeah, Carla, you came and said, I've got people chomping at the bit. They just want to go. They already know this stuff. What can we do? And this is it, right? And that's usually our highest level of it, but it's just, yeah, straight to the point. We can get somebody going very, very quickly. I mean, we'll take you through our process and make sure you're a good fit and educated enough, but we can get this moving, very, very quickly. And then we'll come back and we'll do some game plan stuff. We've got, you guys, if you knew what Carlotta and I were planning for you guys, it'd be insane. And we'll come back and do that. So this is for the people that are ready to go or have been like, I don't even know where to start or what to do. You can also just opt in and we'll drip education on you guys. You can see, like, that's the other thing is our list for this is usually very, very small and protected. It's very highly curated, but this is an opportunity for you to see the deals and get familiar with it and understand the language. And even if you just sit there for 3 or 6 or 12 months, just getting exposed to what you've never been exposed to, then you can raise your hand at any time and say, hey, I think I'm ready to actually go. And we can do that as well.
Yep. I love it. I love it. Well, guys, if I'm trying to bring you guys all the things you want. So if I hope this was it, you'll let me know. And I know people will come and talk and so forth, but Liberty said she just signed up. Yeah, Liberty, you need to get on a call with them. Like, you are one of the people I was like, okay, Liberty needs this. So, and there's definitely several more. So, Brad, if we will see you next month or the month after, as soon as we can get back on your schedule. Yep. And we'll talk about the life insurance stuff, guys. He does some amazing stuff with that. That's very tax advantaged. It's super awesome.
I won't do anything that you have to pay more than single digits in tax. It's just not even worth it. So all of everything is, let's take all the tax savings, roll it, and never deal with the IRS ever again. That's our objective.
Yeah. And that's what I love about, you don't find very many investors that are also tax freaks. And Brad is a tax freak. That's why we get along, because he loves the tax and he loves the code, and he'll do presentations on tax. And he's like, Carlotta makes me nervous when she's here, because she's like looking at all my tax presentations, but he's a nerd like I am. So that's why I brought him, because I know that he is super focused on saving you tax dollars. And I'm focused on saving you tax dollars. And that's why you're in this circle. So if anyone has any more questions, you guys can let me know and I will ask Brad. And if nothing else, you guys need to be on the email list. And we'll also send this out to our group they like to have it in an email, because they don't want to go back and watch the video, some of them, or they want to fast forward. So we'll tell them where to get the hits. And let's do this. And guys, thank you so much for being here. And
give Carlotta your feedback. We'll come back in and answer more questions or do, like I said, Carlotta's finally worn me down to just open up basically everything that we're doing. And so whatever your questions come in, if we've got something, we'll come back in and we'll show it to you guys. It'll be great.
Awesome. Well, thank you so much, Brad, for being here. And I appreciate you guys, and I will let you guys go, because I know we're about 15 minutes over, but thank you. And I appreciate you, and I can't wait to see where we go.
All right.